While the masses stood in a panicked line outside the Banco de la Nación in 1931, Eduardo Ferrante quietly reached for a tin box of gold coins, knowing a secret that history repeats with brutal precision. From the 15,000% hyperinflation of the Hungarian penge to the total collapse of John Law's paper system in 1720, the winners of every financial catastrophe share one trait: they abandoned the state's promises for assets with intrinsic value. This is the mechanism of survival that separates those who lose everything from those who buy the world at floor prices. In the dim, early light of 1931, the San Telmo neighborhood of Buenos Aires remained hushed as Eduardo Ferrante, a modest dry goods merchant, performed an act of quiet defiance. At 6 o'clock in the morning, he woke his son and clerk, Miguel, with a single, haunting command: "Don't go to the bank today." Miguel, however, viewed his father's caution through the lens of a generational divide, dismissing the warning as the rattling of a ghost, an outdated, instinctive tremor that elderly men feel whenever the winds of the market shift. It was a classic miscalculation. By 8 a.m., Miguel had already joined the growing queue of anxious depositors, unaware that by that very afternoon, the doors of Banco Dean would shutter forever, never to reopen their gates to the public. While his son waited in a line destined for ruin, Eduardo reached beneath his shop counter and pulled out a simple tin box. From it, he retrieved gold coins, slipping them into his pocket in silence. He had already said all that needed to be said. Conventional wisdom suggests that those who hold cash are the victors when a crisis strikes, yet history reveals the brutal opposite to be true. In every major banking collapse, cash is not found in the pockets of the survivors, it is found in the hands of those who go under. True value is preserved only by what the state has not promised and what an institution has not guaranteed. This is not a matter of luck, but a cold, historical mechanism. We see this mechanism clearly in 1720 France during the spectacular implosion of John Law's Mississippi Company. As the first systematic experiment in central banking and paper currency began to fray, Parisian merchants split into two camps. One group treated their paper notes like a magic wand, a financial tool they believed would grant them perpetual leverage. The other group ignored Law's personal recommendations to convert, stubbornly clinging to their physical louis d'or gold coins. When the system collapsed, the paper currency was zeroed out in a matter of weeks. The gold holders didn't just survive, they became the new aristocracy, purchasing the estates of their bankrupt rivals at absolute floor prices. Because Law's innovation was an unprecedented monetary policy built entirely on the fragile scaffolding of trust, its disintegration was total. When that trust vanished, the void left behind was absolute. To see how trust can be an illusion, one must look at 1890s Istanbul during the final, flickering period of the Ottoman Empire. In the final twilight of the Ottoman Empire, the Cumhuriyet Umumi, or the Public Debt Administration, was established to oversee the state's external debt for the benefit of foreign creditors. For the affluent Greek and Armenian merchant classes of Istanbul, Ottoman government bonds appeared to be the ultimate safe harbor, a paper promise anchored by the sovereign might of the state. However, the sobering reality was that the state had already descended into bankruptcy. In the decades that followed, those who clung to these bonds watched their wealth and their very country evaporate. Conversely, those who diversified into tangible assets such as land, real estate, and precious metals emerged from the wreckage with their foundations intact. This historical lesson remained consistent even as the geography shifted to Hungary in 1944. During the closing chaos of the Second World War, the penge spiraled into the most aggressive hyperinflation ever documented. Monthly inflation rates swung wildly between 15,000% and a staggering 400 trillion%. At these magnitudes, traditional economic metrics stop being useful tools and start becoming a form of abstract, terrifying fiction. Testimonies from Budapest during this era reveal a stark divide. Families holding gold, jewelry, or foreign currency managed to sustain the basic rhythms of daily life. Meanwhile, those tethered to the penge woke each morning to find that their purchasing power had been slashed by 80% in a single day. This was a brutal masterclass in the speed at which a state can sacrifice its own currency, a process that is often a sudden rupture rather than a slow decay. Even in more modern contexts, like the Philippines in 1983, the pattern holds. As the Marcos regime buckled under political strain, the middle class in Manila held their savings primarily in pesos. When the central bank's foreign exchange reserves were exhausted, The government clamped down with capital controls, freezing foreign currency accounts and forcibly converting them at predatory, off-market rates. Those who held physical gold or dollars escaped this legislative vacuum because the state simply cannot exert its authority over what it cannot physically reach. This reveals the true essence of gold's historical value. It is defined not by how easily it can be moved, but by its absolute institutional inaccessibility. While the 2013 bail-in devastated the majority, a select group of families, primarily the second generation of Cyprus's wealthy elite, remained remarkably unscathed. Since 2010, these individuals had been methodically shifting their wealth away from digital ledgers and into physical, tangible assets. What is striking is that these survivors possessed no special crystal ball. They had not specifically predicted the banking collapse. Instead, they had simply mastered the habit of exiting the theater before the doors were barred, trading abstract promises for concrete reality. This transition is not born of luck, but of an understanding of how sovereign debt functions. For any government, printing money remains the path of least resistance. Raising taxes is a political landmine, and austerity measures inevitably trigger fierce social backlash. Consequently, states choose to hollow out the currency from the inside, like a structure being quietly consumed by termites. The damage of this hollowing occurs silently, and its full impact arrives with a calculated delay. This temporal gap is a deliberate buffer, a waiting room where institutions can extend their own survival while the public's trust slowly erodes. Because daily life requires the currency to function, citizens find themselves trapped in the system even as they begin to doubt it. By the time that window of opportunity slams shut, anyone still holding cash has already been left behind. This reality dictates a very specific set of rules for wealth preservation. Physical assets do not protect you if you wait until the moment of catastrophe to acquire them. Their power lies in being held when you feel you need them least. Attempting to secure gold in the heat of a panic is a losing game. By then, the price spreads have yawned wide, inventories have vanished, and you are forced to make life-altering decisions under extreme psychological duress. The survivors in Cyprus, Hungary, and the Philippines did not accurately read the specific timing of their respective crises. Rather, they read the underlying architecture of the financial system itself. They observed that every institutional structure contains an inherent mechanism of decay. This realization exposes the dangerous myth of traditional diversification. Most investors think they are safe by spreading wealth across different countries, sectors, or currencies. Yet, as history proves, this offers no shelter if all those assets are tethered to the same institutional foundation. True risk is not about where your money is, but whether it remains on the same plane of vulnerability. Whether a deposit sits in a global powerhouse or a local branch, every unit of fiat currency shares the exact same DNA of vulnerability. True diversification is not about spreading wealth across different ledger entries within the same machine. It is the act of stepping entirely outside the system to which those assets are subject. This is a distinction of life-altering importance, yet it remains a lesson most people only internalize after the tuition has been paid in full through a collapsed balance sheet. One must ask why the logic of exiting the institutional web is so routinely ignored by the masses. The answer lies in the massive, invisible cost of nonconformity that modern society extracts from the skeptic. Choosing to hold physical assets is inherently impractical. It demands an appetite for insurance premiums, secure storage fees, and the acceptance of significantly lower liquidity compared to a digital swipe. Our modern existence is meticulously designed to reward total compliance with abstract financial instruments. This efficiency acts as a deceptive veil, masking the underlying systemic fragility with the convenience of a smartphone app. It creates a dangerous psychological split where individuals acknowledge the concept of a crisis in the abstract but anchor their daily survival to the concrete rewards of the system. This mental divide effectively prepares the soil for history's greatest financial losses to be reaped by every new generation. Beyond the logistical hurdles, there is a biting social penalty for those who opt out. The individual quietly converting savings into physical gold is rarely celebrated. They are branded as paranoid, antiquated, or simply too slow to grasp the genius of modern finance. In contrast, the investor holding a globally diversified portfolio of ETFs and index funds is hailed as sophisticated. During times of calm, the system validates this person with consistent, visible growth, making their confidence feel earned. Yet, complexity within a brittle framework is merely fragility in a more expensive suit. If every piece of a sophisticated portfolio resides within the same institutional architecture, it is like rearranging furniture in different rooms of a building whose foundation is already washing away. This explains why patterns of ruin repeat rather than being corrected. Many people read history, but reading about a fire while sitting in a temperature-controlled library produces a different conviction than feeling the heat on your skin. When an investor is embedded in a functioning system, the seductive pull of monthly returns and digital convenience often overpowers the distant echoes of historical warnings. History, for most, is relegated to a collection of stories about other people in other times, rather than being recognized as a recurring cycle of mechanical failure. The harsh reality of this mechanism is usually experienced only when the window for a comfortable exit has slammed shut. It is a striking pattern. In nearly every major financial collapse, the warning signs were never actually hidden. The insolvency of the Ottoman government was etched into public numbers for anyone willing to look. The expansion of the Mississippi Company was transparently unsustainable to contemporary observers. Even in Cyprus, public data showed a banking sector holding assets worth 8 times the national GDP before the 2013 explosion. The people who lost everything were not necessarily uninformed. They were often quite aware, yet they chose to remain tethered to the system because it was still functioning, because their neighbors were still participating, and because the immediate cost of nonconformity felt more painful than the theoretical risk of a crash. This is not a matter of stupidity, but a deeply human calculation, a psychological gravity that every collapsing system utilizes to buy itself a few more months of borrowed time. Today, the indicators are flashing with a familiar intensity. Central bank balance sheets have ballooned to between 10 and 15 times their pre-2008 size. The IMF, in its 2023 report, noted that global public debt is hovering near historical peaks. Simultaneously, pilot projects for central bank digital currencies are active in 37 countries, aiming to establish unprecedented programmable control over money. While these institutions project confidence out loud, their actions tell a different story. The global trend of central banks stacking gold reserves has continued without pause since 2010. They are, in effect, securing the hatches while telling the passengers the sea is calm. When Miguel Ferrante returned home empty-handed in 1931, he didn't bother asking his father how he had predicted the bank's demise. He understood that Eduardo didn't have a crystal ball, he simply possessed a value that did not require anyone else's permission to exist. This is the ultimate secret of the only asset class to survive every banking collapse in history. It is not found in an institutional promise, but in a structure so fundamentally sound that it requires no guarantee from any state or bank to maintain its worth.